piece that can, get us there. The other is that, capital markets have been quite conducive over the last several years. There has been a lot of domestic savings that have moved into the capital markets. So today, if we were to look at the kind of FIs putting in money and, domestic institutions putting in money, there are more domestic funds and investors that are actually taking part in IPOs or follow-on offerings, etc., vis-a-vis foreign institutional investors. So things are dramatically changing on that front, on the capital markets. And, SEBI is adding more and more innovative products. So, few years back, they added InvITs, which is a bond plus or a hybrid security that does not offer equity-like returns, but offers higher returns than debt. So you've got road assets, you've got transmission assets under InvITs, you've got warehousing assets under InvITs, and a few more will come up, right? So, I think that will help deepen capital markets and improve further.
Yeah, so I think I'll take the point what Mr. Jain said about the supply of capital. So I think one unique change that we are seeing right now in this cycle is that there has been a lot of retailization of the capital. So, if you've been tracking the flows that are coming through SIPs, 25,000 crores a month, net equity inflows coming 30,000, 40,000 crores, mind-boggling. We have come to this stage, but how has it happened? If we look back and see, a lot of things actually came together in place for this to happen. I remember, so when I say in 2011-12, I tried to open my first, broking account. There was a huge deal of paperwork. I had to sign a power of attorney, send it to the broker. There were a lot of frictions in the way. Now, when you guys try to open a broking account, you will possibly do a KYC using your Aadhaar. You will pay the funds by UPI. Everything is like, in few seconds. So all the frictions in the way has gone. Internet connectivity has reached to nook and corner of the country and possibly among the cheapest in the globe. So all these things have come together in the last maybe 7-8 years. And then due to COVID and further proliferation of use of internet, remote work, everything, I think these have altogether enabled our population en masse to provide their capital. I think this is something that possibly is going to continue for a long time. I think there are case studies from other geographies that highlight that when such a situation happens, that it continues for a long period of time. I think it's just the start of a cycle that supply will continue to come. And increasingly, if you track the data, I think more and more people from even tier 2, tier 3 cities are coming into this foray. We can talk about numbers. So I don't, how many people would be there who would be actively trading in the equity markets right now? NSE data shows that it is less than 5 crores at this point of time. So the headroom is huge. I think the supply will continue to come. There might be cycles, market sentiments are there, but I think there is a long runway to go.
Thank you. I feel that as per the calculation of all of your expertise is correct, it is not very hard to reach 5 trillion economy by 27. But it depends on the you people. How many you are going to start an enterprise and create a job. And the capital market is ready to provide the capital if you are create the demand on that. So this is one side. Next, my side on that learning, there is a two model of development of economy. One model is called that the trickle down. If we like to, lot of big industry are prepared, people will get the job and people will get the benefit of that. So another one is an trickle up. if you like to large number of population created as an entrepreneur, and they are small amount of income increase or benefited to them. So that will be like to better way your economy grow faster than the trickle down. So as a India, we have that a lot of opportunities. That is an demographic dividend, whatever we talked about it. Second point on the 50% of these women are till now they are not coming to this the income generating program. So how we can be enhance them to come in there? When they are started to come and income is increased, if it's a one name I mentioned on that, if it is in hard income increase is at 10,000 to 50,000 rupees, it will be created huge economic growth in country, because their capacity will build up, the consumer demand is increased, housing demand will increase. No, so this is will be help to the economy or more. I hope that the India, whatever that the pushing on that microcredit, pushing on that the MSME development, it helped to the India to economy grow in that level. Not only the 27 is a 5 trillion, any trillion we can be like to achieve on that. This is my, thank you.
Thank you for the insights. Another part of the GDP growth will be the story from the lending side or the credit side. How is the credit cycle shaping up? We already have stories that possibly the middle income class is stagnating. So income and consumption, if they are stagnating, it's important to understand how credit growth is going to be in the near future. I think we have experience enough to answer this. I'll leave it to the panel to decide who will initiate.
Are seeing a lot of problems, especially MFI credit card, and then next level is the personal loan. So it's become very difficult because last 4 years the credit cycle was good, all the banks were focusing on this segment, and this was a kind of high yielding segment, so contributing to the bottom line. But with this segment drying up, and on the other side the cost of funds is not showing, and on the other side the cost of funds not showing any sign of reduction. So what's happening on the fund side? So money is either moving to the mutual fund side, equity, and then whatever is left, the banks are competing for that small kitty, and within that your low cost deposits share is reducing. So if you look at the CASA ratio, which really contributes to the NIM of the bank, it's shrinking, and more money is coming from the term deposit, so which is a costliest form of capital for the bank, and after that it's a borrowing. So tough environment for the bank. So I think bank can continue to focus on the SME, so where the growth should be there. So that is the part if bank focus, and depending upon the size of the bank, they can focus on the large corporates going down to mid corporate and small corporate. But the credit growth will be there because leverage will be there in the economy. You can't expect everybody to pay off their debts and be clean, relying on their own internal source of capital. So I think opportunity is there. The only thing is how bank can raise their money and deploy is more efficiently.
Correct this the fact on that. The credit growth and deposit growth, there is a big gap. So credit growth till now 4.5% higher than the deposit growth. So credit is not the issue. Issue is there the how we are careful about that the credit underwriting on that. Not in a unsecured issue. If you see that the 10 years before, we are issue of corporate credit, then all are going to retail. And now retail also is there, then going to unsecured. So it is a seasonal matter, I feel that. So we are also bankers are careful about it on that, about the credit underwriting, how we can be like to careful about it. And of course, there is one issue is coming on that. There is an fintech. So fintech lending on the basis of credit bureau data. So sometimes the credit bureau data only not can be like to select the amount and customer, how much you will be like to disburse. So everyone learning from that, all the channels, what is happening on that. And they are also correcting about it. And I hope that that is a temporary issue. It will be like to come again, all that normal. Point is there, the credit is not the issue from banking side. It is coming, flow is good. Of course, the cost is little bit higher, and we know that what is the cause. And so very tough, some of the organization or some of the person take the loan in that cost to sustain their business growth on that. So this is a challenge, but it is a for the time being on that. Thank you.
So one curious thing I will just add that in that. So bank can borrow money and bank can raise deposit. Sometimes borrowing is cheap because if you have your sources are available in terms of refinance and short period loans from money markets, and you can roll over. So all kind of strategies are there. But the only problem is today regulator is looking at another ratio of NSFR, stable funding ratio. The more stable fund you have, the higher will be the CD ratio, which regulator is also now struggling today to find where it should stop. So while credit deposit ratio, you look at a gap, but that gap can be funded by the borrowing. And within borrowing, you have got the green bond, yellow bond, blue bond, infra bonds, so which are more efficient than deposit because CRR, SLR is not there. So that's the interesting thing now, which is happening.
To add another perspective, for borrowers, a new channel has come up to raise capital, which is all of these credit AIF funds, right? So these are CAT2 AIFs, which is a SEBI regulation. A lot of these are funded by global sovereign pension funds with Indian money managers. And capital is moving into avenues where a typical bank may not lend, right? So for example, for real estate, lending for acquiring land is not available, but a CAT2 AIF can take that call and put out capital. Of course, it comes in at a different price, right? But there is capital available for that. There can be capital for special situations. So there are special situation funds, which means is that, if a company is highly over-levered, there is too much bank debt, there can be potential default from the banking system, then you can get CAT2 AIFs and kind of pay off that debt, and you may get a little runway to bring your business back on stream and pay off that CAT2 AIFs. So it's flexible capital that's coming in the market, and it's also credit. So it's equivalent to lending. There is a fixed cost to it. It is not equity. You have to pay it back. And, interestingly, Ravi, from your perspective, what we're also seeing, a lot of domestic individuals, HNIs, are also putting in money in such funds, right? Because they offer a certain fixed return. So they're also keen to participate in this journey. So we're realizing that a lot of these are backed by global sovereign pension funds, but then they do go and take money from domestic markets. So a lot of private wealth houses are distributing that paper across. So I just thought,
Yeah, that's true. We have increasing participation and basically the interest we have from family offices and investors across is a more sustainable way of generating cash flows and the fixed incomes in their portfolios. So the shift is from the conventional debt products to more sustainable fixed income from exotic investments by lending.
what they said, that from conventional fixed deposits, etc.,
Yeah.
people are now taking the little leap to say, I can take a little bit more of risk, right? And then there are managers like you, like others in the market, who are able to explain that risk out to people. So people are getting sophisticated enough to say, listen, maybe I should diversify some bit of my capital into such avenues to see what kind of higher returns can be made.
High net worth people, they are paying the 50% tax on their deposit or fixed deposit or savings. But when they are going to the capital market, or rather on that, their tax is 12% or so that they are now thinking in that line, whatever you mentioned on that, the other road, how they can be like to pay lesser tax, earn much more.
Yeah, I mean, I think I would fully agree with that, sir. Even not even at the maybe ultra high net worth or high net worth level, but generally at a mass affluent level also, I think post the taxation changes on the debt side, anyways, term deposits had a higher tax rate, but even on the other debt products post the taxation changes, there has been also some affinity which is visible, that people trying to look at relatively safer instruments than equities, maybe slightly lower risk, but hybrid schemes which will get treated as equity assets in terms of taxation, but will still give maybe lower risk and better return than conventional debt products. So that tax planning also is playing a role, I guess, in this.
But in the interest of the 200 odd aspiring entrepreneurs sitting here, so the question is now, how do we engineer higher participation from the massive middle class or the middle base which we have, where you mentioned that the consumption is stagnating. So if the consumption is stagnating, then is savings increasing? And if the savings is increasing, is it because there is no avenues to invest? And if that be the case, should regulators, financial engineers come up with avenues for people to invest, to place trust in new ventures? So how do I give 200 aspiring entrepreneurs the confidence that you can go ahead and fail in your first venture? There is a fund that caters to failures. How do we do that? That is something that would probably help in propelling growth.
So taking a cue from Mr. Josefa, how is this AIF space is playing out in the capital market these days? Because you mentioned about only Cat 2 in terms of moving the money from the traditional banking space to AIFs. How big is this market? Can you share with the audience and some more details?
So I can talk on the Cat 2 AIF market. Cat 2 AIF market, though, is not permitted to invest in listed equities, right? So it's more private investments. These are investments that can be made in public or private listed companies. They are investment, and it can be made for multiple purposes. So, one could be for new manufacturing expansion. The other could be in terms of if you've got too much debt and you are over levered and you need some bit of leeway till your business stabilizes. So they provide you that leeway there. Because if you were to go out to private equity, or say even if you were to list in the current market environment, promoters may not get the right valuations because they're over levered in the first place. So then what do? What's the avenue for growth if you still are ambitious enough for growth and if you're seeing enough and more opportunity? So you see these funds building that bridge in between. So you'll get a leeway of about, say, 2 to 4 years. This will be very flexible capital. So there will be principal moratoriums. There can be interest moratoriums for a certain point of time, and it compounds. Now, because it's flexible capital, it comes in at different varied costs. right? So the costs are aligned with respect to the risk, right? So they will fund your equity. They can fund, they will kind of, they'll fund your portion of the equity. They will kind of take in, cash collateral. They will take hard security. They will look at the existing business. So they will look at two avenues. They will underwrite credit, and they will also underwrite an element of a potential equity upside, right? So they'll take a call on both. So this is a new stream that kind of has come up. And, to answer your question is, a lot of times companies take the plunge, take Cat 2 AIFs, build the business, and they may convert some bit of their loans to equity and then publicly list. So we're seeing that also as an avenue, where some of the funds are saying, listen, I'm giving you a portion of capital, some of which you repatriate, and some I have the option to convert to equity. So if I have underwritten credit and equity risk, and I realize that I'm in the money on equity, I will write the equity. So I'll convert my debt into equity, and then we will go in and list. So such stories are coming to the market, and they're listing in this market. So I think that's how these funds, at least on the Cat 2 AIFs, are also kind of, propelling good stories, good companies to come across to the capital markets. The other is that, these are funds which are very sector agnostic. So they can underwrite promoters across stories, across sectors, across geographies. They typically have no bar, right? So they will look at good promoters, fundamental, sound businesses, and they're willing to bet. So, now sometimes businesses get categorized as boring businesses, new age businesses. They're very happy to lend to boring businesses as well, right? They're happy to lend to boring businesses in tier 1 cities, tier 2 cities, tier 3 cities, as long as they find promoter quality is good and business is fundamentally strong. They will provide that capital to them. So that's deepening of capital being available to promoters. From individuals' perspective, from people here, they could also look at aspirations in such funds, in such situations, because it opens up various avenues or opportunities, right, for people to participate. So
Yes.
And how do you see this technology adoption in the Indian space, and how it is changing the regulation landscape as well? Because Mr. Ghosh talked about fintech. One of the distinguishing mark of fintech versus bank in this fight is one is in completely much regulated space, one is in slightly less regulated space. So the competition landscape is not possibly at par. So how do you think technology as an enabler in the regulation space?
See, the trouble is that the industry, financial industry across the world has been very reactive, right? We wait for a scam and then we think about what to do about it. So, so we learn from scams. So I think governance regulation has to be more proactive. Maybe looking into the potential dangers of exceeding our speed limits. We talk about high frequency trading. We talk about algo trading. Does that give the owners of that technology an unfair, leverage against the rest of them, or how do you kind of make it fair play for everybody, right? At some point there will be price discovery. At some point there will be it'll find its place. But then till then, I guess it's just a natural course we need to take, and there is no other way out. The regulator learns from adventure, right, that anybody takes in the financial space too. I think we've seen what's happened in crypto. We've seen what's happened across. Initially, there was resistance to that change, of course, from the traditional banking system. And then slowly it started adapting across. And now, to the extent that the US is almost dependent on it, calling it their second fallback, second to gold. So what do we do about that? So these are pivotal changes that come about, but then we need to kind of brace ourselves for such adventures in the financial space till they play themselves out as a safe space for people to participate comfortably. Again, investor education, I think, would play a vital role here. So, again, how do I get the middle class to participate, right? How do I educate them about the risk that they're taking while everybody is focusing on the kind of returns that they're going to be able to make, and therefore take a plunge into the wrong investment option, after which they complain, after which the regulator comes up with rules, after which we banks have to sacrifice our margins. And that's what's been happening for a few years. So investor education is key, and I think we need to find more innovative ways of drip feeding that education to the potential middle class investors.
Mr. Ghosh, how do you see technology as an enabler for financial inclusion? You have a vast experience in this. Pre-technology.
Technology, one side is there, it has been helped to reduce the cost of operation. That's the one side. But technology also increase the fraud. So that is also is different. So very important on that will be like to give the financial technology education to the customer. Very good way. What they will do. Because I'm talking technology. So that is in one issue, and that those are doing this type of fraud. They are smarter than us. No, whatever we are trying to protect, immediately they are taking in another way on that. So it is only possible on that. Not only the bank can be like to solve this issue. It also will be like to educate the large number of people. That is a very much crucial financial literacy about the technology. That will be very much important on that. Otherwise, there is no other way to save on that.
So you'll add something on technology adoption in the...
Yeah, I think overall for the capital markets, whatever we are seeing right now, of course, technology has been a major source. The streamlining of information in the capital markets kind of strive to make the market more efficient. There is better and faster price discovery that happens because technology has enabled this information flows. But yes, like Mr. Ghosh says, that with anything that comes around, there is a downside risk that is there that needs to be clearly thought about. I think a lot of this evolving risks that are there, and we keep on hearing new and new variants of these kind of scams every day. I think it might be difficult as such to preempt this, but a general awareness in public that whatever seems to be too good to be true is possibly not true is something that needs to be spread around so as to reap better benefits of technology than to lose from it.
Right. So, yeah, please.
So the only worry about technology that when you use these kind of things, there comes a lot of responsibility also. And on the other side, when it is misused rather than being used, then the problems start. Like AI. Now AI is being used for fraud. than being used for productive purpose. So today you don't know. You have a phone call, you got an email, you know how authentic it is.
Voice guess. Yes, absolutely voice. Absolutely. So just changing a track slightly, we have now growing focus on climate, ESG, impact investing, how climate is shaping up lives, livelihoods, and so. So how do you see these concerns for climate, environmental, social, shaping up investor behavior, maybe consumer behavior, and the industry as such? So industry perspectives, please.
Yeah, so I think ESG is already starting to become a very big thing. I think in the developed markets, particularly in part as part of investment assessment, I think this plays a major role. In India, we are now seeing avenues or vehicles through which particularly ESG focused investment is shaping up. It is a critical factor. So I can give you an example how globally one of the sectors where we see that there has been a major impact of this climate change, that is the insurance and the reinsurance sectors. These are the places where I think increased catastrophe events which are happening as a function of climate change continues to have an impact on profitability. So what has the industry also done to kind of work with this? Overseas, there are products available called catastrophe bonds, which provide capital so as to circumvent losses in this kind of situations. So hopefully in India also these developments will play a role. Additionally, I think social investing is a major factor. We have seen organizations who have come up with investment funds which focus on the social side, and this kind of helps overall uplift the different socioeconomic groups where there is a requirement of support. So I think this whole lacuna is gradually shaping up in India in that way. And I think one area where emerging leaders like you all can play a bigger role in that. And as our institute has focused on sustainability from day one, I think you guys have a big role to play in this part.
So I'll share a perspective from what I see on the M&A front in terms of ESG. Over the last 2 years, any diligence that we've done for any corporate in India across sectors, there has been a new diligence that has come about, which is ESG diligence, right? So earlier we did accounts, finance, tax, legal. Now you come up with a ESG checklist, right? So they, all acquirers, all investors are looking at ESG very keenly across any of the companies they're investing in. All of them hire third-party consultants. Some of them are global consultants. Some of them are local consultants to do the diligence. And interestingly, what we see is that all of these frameworks are evolving. It's not a very rigid diligence that we see. They tell us that you tell us what you are doing in terms of ESG. We will give you our inputs. Whatever may those inputs be, let's try and evolve a mechanism that in a time-bound manner you come to that implementation. The implementation of that, we leave it to the company. Right? So they're not putting in targets to say, listen, we need you to comply within 3 months, 4 months, 6 months, none of that. But they're saying, listen, this is mandatory for us. We will come back with our study, whatever it says, and you give us and guide us towards timelines that work for you. Right? So this is becoming very critical. That's the first part. Second is that, as he also touched upon, a lot of impact funds, climate funds are making investments in technology, new businesses that are focused on sustainability, climate change, battery, electric vehicles. So that's another massive funds that are investing, right? There are a lot of global funds that are climate focused, or transition funds who are moving from, say, regular fuels to, say, alternative fuels. So say LNG powered vehicles. There are LNG powered vehicles, right? And there are funds who kind of look at making such investments because companies are looking at those kind of investments. So this is happening across all sectors again, right? So that's the second piece. The third, just to touch upon in terms of real estate, a lot of the real estate, largely commercial assets, people are looking at it and saying this needs to be, global standards. So there are standards which is LEED gold, silver, gold, platinum, right? So then they kind of focus on, you reducing air conditioning costs, reducing, your water in terms of water intake, better quality of air. So a lot of these buildings are being graded with such, grading agencies, and corporates are being pushed to move into such assets, right? Because they need to show in their annual reports also ESG. So there's a chapter on ESG in almost all annual reports, right? So they will want to say that, okay, our headquarters has moved to, A building, which is, LEED platinum, and that speaks for itself. So that's a shift that we're seeing even on the hard assets or real estate side. So all in all, if I had to summarize, we're seeing it in every strata of deal making assets that we're doing in the marketplace today. ESG is a very critical component for global strategic investors as well as for investors investing in a company. And just to double click on this nuance, investors are also focused on it because their LPs globally are focused on it. So the LPs are the fund owners who are putting in money in the funds, and those LPs have ESG norms, and that's driving the funds to have ESG norms, and they're making ESG investments. So it's kind of a full line alignment across.
So one of the things I was a bit surprised about is about a year back we were discussing at one of our investor discussions that the global GDP has reached X amount. And two of us were just talking to each other saying, versus what? Mars? I mean, who are we competing with, right? So this just, we have finite resources. So if ESG and climate has to be a target, then obviously we've not woken up. So if that becomes a consumer mindset to consume responsibly, and that again drives our conscience towards the environment and also makes things sustainable. So that has to be a mindset right from the ground up and not necessarily only for the big corporations. So that's probably what's going to make a change. So that's just my view on it, not that I have any expert opinion or expertise in this area.
As you have rightly said, most of the investors are now looking at how much of their money is being invested into ESG compliant fund. So they are really pushing for it. And if you look at it, the government, Indian government is committed by 2070 zero emissions. And today 46% of energy is produced from the renewables. I'm saying that kind of change is happening now.
I can agree with Robbie. One point is that I do not know the definition in that sense. Can we stop the first foot? It is a large number of population using it. So how we can be like to change our behavior? Why we have been shifted from bicycle to motorcycle? Which one is environmentally best? If you see that the city, any city, how much motorcycle have been standing in the signal. No, so now bicycle is a fashion. Means in that exercise people are using only bicycle. No, we should be like to large number of users who are consumers. How we can educate them about this, the environmental issue. Not only it is in top level. Again, I am saying that it's a need to educate the bottom level on that. I have not yet stopped my son to eat the fast food. He's not agree me. How I am contributing to the environment. I am not controlling my son. No. Have we said that the denied to take the plastic? No. We are happy. We are taking ice cream and all the packet, we are put it on the roadside. It's not impacted to the environment. So we should be like to very clearly explain, educate what is the biggest impact happening for environment. And that can be like to. It's a new thing, is a climate change. We are talking about it, afforestation. What is we are doing? How many are construction we are doing by this, the real estate people? And how many trees they are planted? We should be like to go that way. I cannot be like to plan parts of your real estate if you're not like to plant it that much of the tree. I say that this is the way we can be like to save ourselves. If we go to this another way on that, when you go to the bathroom, shaving, total call is open. Water, free water, passing on that. How many we are conscious about it on that? In the time of shaving, we'll be not like to full time open the tap. This is the misuse of water. The water will be like to future of our environment impact. So all this, the small thing, it can be huge impact of our country and society. We should be like to look on that line. Sorry, I'm not the banking point of view talking. I'm talking that ground level. Thank you.
Thank you, everyone. A quick question, because you said that in all annual reports, there are more words on climate and ESG.
Big book.
Big book, yes, yes, and there are a lot of research that. Absolutely. So my question is, suppose some front we have a policy that let all corporates declare earnings earned per unit of resource consumed. Do you think this will be well accepted in the market?
So, no.
Or the reverse of that? Resource consumed per unit earnings.
Per unit of earnings. See, I think ESG in India, while there is a strong, there is a strong voice on it, people are following it, it's still some time away till you have fair frameworks for ESG that is comparable across industries, right? So I'll give you an example. A services industry like financial services may have different ESG frameworks required than manufacturing, then real estate, then healthcare, right? So right now, what I understand is that a lot of the local consultants are preparing certain frameworks specific to the sector that they're focused on, right? So I think to answer your question, we are some time away for that to come in as a criteria, right? To say that what is my earnings or what is my resources spent per rupee earned, in something in that manner, because not all are actually focused on measuring it uniformly, right? So it's a fair metric to have, But I think it's some time away, a few years away, and then maybe we could get there. But just to answer the question, what we see in annual reports are, say people are talking about, say for example, for real estate, they talk about X percentage of electricity consumed is through solar or wind, right? So, they can say that our portfolio today is 25% through renewable sources of energy. And in the next 5 years, we're trying to push this up to 50% by making so much investments. And then they talk about those investments, and there are funds who will allow them to make those investments. So that's the interesting part. So, if I had to just again bring it into a bonds framework, there are those green bonds, right? I think they can talk, Chandrasekhar and Gobind can talk more on it. But globally, there are a few, a lot of green bonds that have got issued for exactly these purposes, to invest in renewable sources of energy. So that's, I think, also kind of shaping up in the ecosystem, right? So it's very interesting. All I would say is still in the infancy at this point of time.
No, I will only add that yes, he rightly said today it's more like consultant is painting a rosy picture than something useful happening, but it has created an awareness now. So investors or regulators are really pushing. So hopefully in a few years to come it will become a behavior. It is kind of a learning.
Right. So I think we are at the end of the time given to us. So I'll just take few questions. If
Good evening. My name is Vishak Dhingra, and you spoke about the consumption slowdown in the country. And today you had the Q2 numbers come in, which talked about how the country is only grown at 5.4% compared to last year's 8.1%. So the post-pandemic, the pent-up demand is almost over. You're seeing a slowdown, and monetary policy at the moment, the rates are quite high. So would you be expecting a rate cut this December, where we are supposed to announce one on 6th December, or are we expecting to see something in early 2025? And my second part to that is, how long does it take for you people as the banks to actually realize the gains from such a rate cut?
I don't know about expectations, but we've been praying.
No, if you look at it, so whether it's production, consumption, it's not constant throughout the year. It keeps on changing depending on different factors. And some factor could be related to the way the data is collected also. So don't be sure of that whatever is collected is 100% correct. So don't get swayed by something said or something like that. And India being having one of the largest population, 70% is consumption is in-house. So that's why our GDP is growing faster than the other economies where you see the recession now. The consumption is happening, supply is there, so economy is growing. Second, how banks take advantage or financial institutions take advantage of the rate cut whenever it comes, it has some lag effect. So what happens in the anticipation of the rate cut, people already lock in their rates. So already it takes time for that deposit cost or the borrowing cost or funding cost to come down. While in the lending, it starts becoming visible very early. So very difficult to say. Depending upon the portfolio of a bank or what kind of portfolio you are carrying and what kind of resources you have raised, it depends upon, it's a function of that.
Good evening,
Just-
sir. My name is Avirup.
Yeah, just to give you two more perspectives on what you said. One is that also consider the higher base effect of higher growth in the prior years. So then the growth over growth is kind of little limited. Also, from an economic perspective, economies need to be looked at in a cycle. So typically a 10-year cycle. So COVID disrupted that cycle, right? Because there was a massive shift. I mean, none of us had imagined how things would shape up, right? Technology, businesses, financial services sectors. So there was a kind of shifting of the normal growth engine of an economy, right? And then we've had political changes globally that has also benefited India. So, if you look at the economy in a 10-year cycle, one should also look at private capex investments. And as those are increasing, that benefit comes over time again, right? So the point I'm trying to make is that look at the numbers for the private capex today, capacity utilization for, say, manufacturing as a sector. So it's about at 70-75% people put in more money for new capex. And that's what's happening in the country right now. And then that creates the next cycle of an upcycle for growth. Yeah. Yeah, absolutely. Yeah, absolutely.
Good evening, sir. My name is Avirup Banerjee. Sir, Bandhan Bank is one of the few examples of a banking organization growing from the eastern part of India. So, sir, my question is to the panel in general also. So, what are the challenges that a banking institution faces specifically to the part of Eastern India and Northeast India specifically, and what are the perspectives that they can improve on, and how can be the banking sector landscape in the Northeast India and the eastern part of India can be changed?
The one answer is there, the Bandhan Bank is now pan India. And second, the point what you mentioned about East India, is it depend on people trust. No, if I say that the given before I came to the work in East Northeast, suppose Assam and Tripura, after the Bengal. So it is hopefully 2005-6 I came. When I first came in here, my bank dictated me, don't lend my money to Assam and Tripura. No. I said, why? No, they cannot repay. No. And then I already opened the branch. And they say that my money you cannot disburse in there. Then I said that, okay, fine. My capital money I'll invest in, disburse in these two states, and your money will be like to Bengal. After 1.5 years, they further lending me and asking how much you lend it to the Northeast, 1% interest discounted. It has been proved. Then our confidence has come. So this is a confidence issue of Eastern India and Northeast India. The banking sector, which I learned, which I given the example on that. So now it is not that much. Now they are know that this is also good investment area. Only need on that the Eastern India and Northeast people should be take their confidence on themselves to start the business. Not going to job for Bangalore and South India. They should be start their job in here. They will be start the enterprise. No, if you see that at the Bengal, especially if you say that Bengal, why I'm mentioning about it, Bengal is the third largest population in the country. No, second largest agriculture production. No, so raw materials is here and people are is here. Why they are not like to go as an entrepreneur? Why they are asking the job? No, if you are asking, are you married? No, okay. Good point on that. So people asking in Bengal, the what is the boy doing? The job. Okay, ready to give the daughter. If it is a business, oh, he has not capacity. Don't give this. So this is the confidence will be like to change. It's coming to change. That is a need on that in Eastern. Thank you.
Thank you, sir.
Good evening, panel. Thank you so much for the insightful discussion. My name is Jeenal Bedala. So about the environment part that we talked about, where Chandrasekhar sir talked about that, why can't we like switch to bicycles, etc. So in today's economy and the lifestyle, it is not possible. But I believe a possible solution to that could be the public transport. But for some reason, India has not yet cracked the public transport system. So where are we going wrong in this, and how can corporations play a part in this?
I have not suggested is the wrong thing. Why you targeted me? No, good on that. You see that there is a lot of limitation. If you go to this, some of the states, they are developed it. If you say that the Bengal, there is a new town city, there is a good, they are prepared a by lane only for cycle. They make it. So now thinking about though that lane have been prepared for the, those are exercise bicycle are running. Not you and me as in professionally going to office. No. So that environment, I feel that the business point of view, if you're thinking about it, so motorcycle is a big business now doing to.
Thank you, sir.
Another point you mentioned about it, country development is not only depend on government. It's a government, corporate, individual, society, all together will be drive. Otherwise, it's not possible. No? Thank you.
Thank you, sir.
Hello. Yeah. Hi, I'm Weber. My question was primarily directed towards Mr. Degamwala. You raised a very interesting point about the evolving ESG landscape in the M&E space. I wanted to understand, do investors mostly see it as a hygiene factor where the absence dissuades them from investing? Or are the investors actively ready to pay a hefty premium for companies doing extremely well on the ESG front, both in the Indian and global context?
So that's a very good question. And you're right. Investors, global strategics and investors will pay a higher price if the company is superbly ESG compliant. So they feel that as a banker, you kind of run sell side processes to try and maximize competitive intensity and maximize prices, right? That's what a banker does. And this piece has become a very important part of our investment thesis, because we also know that in the board or in their IC's decision making, this is an important criteria, that what is the company doing on its ESG journey, right? So that's one part of the response. The other is that a lot of companies are now will say no to making investments in a few sectors. right? So for example, people may not put in money in, say, something related to generation of, say, coal power, etc. Some fossil fuels. Sometimes anything with respect to, there are a few end use sectors that they may not touch upon when they look at climate focus. So then that's also a barrier. So I hope that answers your question.
Good evening, sir. My name is Shubham Singh. So, sir, most of the European countries and in fact US also, they are on the verge of not able to sustain their current population level. So there is one school of thought which says that the population would be on a decline, and which might lead to economic slowdown. So some of the people or some of the experts are suggesting that AI is the only way to cater to the current production level. So I would like to know your thoughts on that.
Sorry. So you're suggesting the European and American population is depleting, and therefore they're looking at solutions to.
Yes, sir. There is a school of thought that they might not able to sustain their current population level, which might lead to an economic slowdown.
Okay.
So they are looking at AI for a solution. That AI can be a perfect replacement for human capability, because the current IQ of AI is already above human levels in almost all the subjects known. So I would like to know your thoughts on that. And will India be into the same?
We will export talent. We will export. But see, I don't know. So the use of AI and robots and all the development that we have in technology probably should aid where we would like human beings to perform more enjoyable tasks, right? Let's say the on-the-ground responsibility that the scavengers take, or the people who are cleaning our drains, who are actually keeping this country running, and every country all over the world. If technology can replace those human beings and actually free them and give them other opportunities to work, to kind of that I think would be more sustainable for us to think as a community, as a society. But as far as you can't have AI replacing human consumers, right? So we need humans to consume, and again responsibly. So I'm sure they'll figure a way out for to deal with their population. But again, this comes back to AI replacing us in the workforce, right? Such evolutions are inevitable, and it only gives us avenues to focus on something that we were probably meant to pursue, right? And if a job can be done by a robot, what was I doing all along is the question, right? So we need to pursue other stuff, and we need to wait for that change to play out, is my thought.
Right, as I was signaled, we have already crossed our time. So this would be the last question. One more? Okay.
Good evening, sir. My name is Swarnam. As we have a discussion about AIF and how is it being instrumental in the economic growth, what are the strategies that we would be looking at to increase participation through from the public as well as the institutions towards the AIF investment?
So, as I mentioned, there is a lot of ultra HNI family offices that are deploying capital to the AIFs that are being managed by various fund managers. I think to increase participation, and this is at the cost of bank deposits, so essentially it's more of education. They need to be more aware of the product, the profile of the product, the risk towards it, and whether they are suited towards it in the first place. Because this is long-term capital. So when you put in money, first of all, the AIFs are limited with a minimum ticket size of 1 crore, right, for a Cat 2 AIF. You need to be able to plow in 1 crore as a minimum, and it is for at least 3 to 4 to 5 years, if not more. So you need to assess the risk, whether it's for you. There has to be better education, because so far, again, and to my banking colleagues, a lot of people that we meet, a lot of corporates, treasuries, a lot of companies, they put in money in fixed deposits because they say, listen, this is risk free. I don't have to be worried about it. It's tension free. There's no risk of capital, because they don't want to go and tell their promoter that there was 100 and now that is 94, right? 2 years later. They could say that 100 is, say, 115. Maybe it could be 125, who knows, but they're happy with that 115. And then we've got all of the money managers like Ravi, who kind of trying to push a bit of that capital to these alternative investment avenues, as it's called. So I think education is very critical. I think they play a very important role, because they reach out to family offices, other wealth managers, corporates, treasuries, to be able to explain the story on that front, right? So I think that is one piece that will help you in better domestic participation. The other is for, intermediaries like financial services firms like us, investment banks like us, where we need to be able to demonstrate the benefit of taking in money from these AIFs to various borrowers, right? Because again, it's a product which is about it's been an old product, right? I wouldn't say this is something which has come up now, but it's gaining more momentum in India, more traction over the last about 3 to 5 years. So increasing
good.
That's
Last
correct.
couple of years.
That's correct.
So that the HNI segment, they are targeted.
Yeah, you're absolutely right.
So that is the main cause. Now it is booming up on that.
Yeah. So HNIs have made a lot of money on the stock markets, right? So when you make a lot of money on the stock markets, then you start thinking that maybe now there'll be a downturn. So you take some chips off the table, and then a smart money manager will come in and say, sir, thoda paisa isme dal do, to equity return nahi hoga, but it's better than a bond or a debt. So that's how this avenue is kind of growing. And this is happening even in the US, right? So there are large credit funds by all of the global private equity. If you Google it, you will see all of them having credit strategies in the US market, in the Indian market. So the other part of it is that for borrowers to get comfortable with such investments, you need people, you need intermediaries, advisors to kind of, explain the risk, the product, see if there is a fit to the business requirement. And the one last piece is that, so far, at least it's not come to, there have been very limited stories of any capital loss or any mass credit failures or defaults from these funds. So it's also onto the end borrower to make sure that the capital taken is returned, right? Because that gives you the strength for the credit managers to kind of keep investing more. So far, I think not too many of such negative stories that have come about. But as there is positivity, money is being made, there is more knowledge in the the capital providers and the borrowers. I think that will create a boon for the AIFs.
Yeah, I think I'll just like to add one point that so one part is, of course, the HNI base has increased, which has resulted in this flow. But if we think about it, mutual fund industry is a 40 lakh crore. The equity part is a 40 lakh crore industry. The AIA piece, so Cat 1, 2, 3, and maybe PMSs together, which are the riskier assets, they should be somewhere around 7 to 8 lakh crores. So what is the reason for this offtake? So it is basically again comes to the friction part of it, that mutual funds are very simplified products where there are no entry exit barriers anymore. You can get in and get out. So that barrier related risk in an investor's mind kind of keeps on keeping them putting more money in mutual fund. And plus the fact that the size restriction, so he mentioned about 1 crore for cat 2. I think cat 3 is 50 lakhs, PMS is at 25 lakhs or something like that. Now, regulators are also playing a very important role. So SEBI has come up with a product definition that says that there will be an intermediate product between a PMS and a mutual fund for, slightly lower upfront capital requirements. These will be incremental sources of capitals which can possibly go into these domains for someone who would like to seek maybe slightly differentiated strategies as opposed to what is provided in the mutual fund landscape right now. So regulations, supply and demand all needs to come together for this all to happen.
Faculty, it becomes very difficult to say stop on the questions. That's the biggest challenge. But thank you all the panel members. My sincere thanks and gratitude to be here and taking active part in this.
On behalf of all the students of IIM Shillong, we would like to extend our heartfelt gratitude to all the panelists, our moderators, and the guests that were here. This was a very insightful session that covered a divergent range of topics.
With this, we would kindly request Sharad sir to do the honors of presenting memento as a token of our appreciation.